Hey, it's Todd again. So here's another question I get often. And the question is, hey, I know interest rates move up and down, but how do different lenders price loans? Because it's really hard to compare different rates among different lenders in a market that moves up and down. So that's a really good question. So in general, interest rates do move up and down every day. But remember, different lenders price loans based on a lot of different factors. And so the rates can vary amongst lenders. So let's talk about that a little bit. So lenders, the income that they receive for each mortgage is very similar for most lending institutions. So it's all about the same. But the rates can vary because of the layers that each lending institution adds on to each loan to determine the final pricing. So these layers are actually called margins. So margins are factored in based on company costs from things like leases, operational efficiencies, desired net revenue, volume, processing. All these different factors go into the cost to originate a loan that is baked into the final price. So overall, companies that typically have higher costs tend to have a little bit higher rates. So that's kind of a generality. So let's think of it in terms of a car dealership. So if you're buying a new car, you get to see on that sticker price the cost of what the dealer paid for that. And you know that may not be an accurate number, but basically they're disclosing to you what that actual cost was and what they required. So keep in mind that most lenders are getting about the same amount of income for each loan that they sell to different investors, the bulk of them going to Fannie Mae and Freddie Mac. So if you think of the new car analogy, there's also all these other costs that are on top of that that determine the final price. So if somebody is buying a car for, dealer's buying it for $18,000, they're adding in all these destination charges, other fees, and other things. So the sticker price may in fact be $20,000. So think of it in that way. But also keep in mind too, if you go to 3 different dealers, that same car, although the dealer purchased it for about the same amount, they could offer it for maybe $22,000, $28,000, $25,000. So you could see 3 different prices for that same car based on the dealer's cost as well as what their profit margin was to be. So this actually happens with rates as well. So what happens is if a lender purchases a loan for the same amount, they may offer that same price for 4.25, 4.5, or even 4.75 at no points. So if you keep in mind that in general, most lenders are going to purchase a loan and they're going to add about 300 to 600 basis points in total to determine the final price. And 100 basis point equals about a point. So the numbers are not important, but just so you know, that's about what the add-on is in terms of what lenders are purchasing and what they're offering rates at. So what that means is the bigger the margins, the higher the price is going to be. So that's why things fluctuate from day to day. Even if rates don't change, 3 different lenders are going to have 3 different prices. So here's what we do at Pacific Residential Partners. We've got 2 very significant advantages that most lenders don't. The first one is the way that we purchase mortgages is we purchase them in a way that's in real time, and it's on an e-commerce trading platform with hundreds of different lenders. So what that means is we've got access to hundreds of different options and loans that are changing in dynamic real-time pricing with the opportunity to purchase those loans at any moment. So it's almost like purchasing a stock, where stocks are going to go up and down, and you can actually go onto a platform and purchase that stock, but it can fluctuate from second to second. So it's the same ability for us that we've got a platform that we can do that with a number of different lenders. And keep in mind that all these lenders are pricing their loans differently based on the same economics, but we get to see what they're offering in almost a real-time standpoint. Most of our lenders are only going to price loans once a day. So what that means is when they're pricing desk wakes up in the morning, they're going to look at the economic outlook, they're going to look at what's happening with all the financial markets, and they're going to determine the price. And that rarely is going to change throughout the day unless there's a significant movement in treasuries or other financial markets. So the second thing is the way our pricing model is set up is we are priced with really no margins. So our platform allows us to compete with the largest mortgage lenders at their deepest incentive, which is really the lowest cost. So the way that we're set up with all of our partners is we get typically the best wholesale price available. The other part of our company is we don't really have any fixed costs. We don't have leases, we don't have staff, we don't have salaries. The most of our team works remotely and then work on a contract basis, and we all outsource just about all of our support and operations. And it really does, our margins don't fluctuate based on loan amount, on product amount, or a transaction. So the other part is we really value the relationships over transactions, and we have our margin set at an extremely competitive rate, which is about less than 30% of the entire industry. So with those costs, we know we can consistently deliver a great experience, a great cost, and a high level of support, and be extremely competitive. So again, Todd Flavio, Pacific Residential Partners. Let us know if you have more information, if you need more information, or we can help in any way. Thank you.